Hello, I am Mike Phua, founder and CEO of YY Group. Thank you for taking time to hear about our fiscal year 2025 results and where we're heading in 2026. 2025 was a year of significant growth for YY Group. We grew full year revenue by 39% to $57.2 million. Gross profit grew even faster, up 50%. And our gross margin expanded to 13.8% from 12.8% the year before. These numbers tell a clear story. Our business is growing in both size and strength. We made a purposeful decision to invest ahead of revenue in 2025, entering new markets, completing strategic acquisition, and building the operational infrastructure to support a much larger businesses. The returns on those investments are now becoming visible. In March, we issued our first formal revenue guidance as a public company. Full year 2026 revenue of $103 million to $110 million, which is around 80% to 90% growth year over year. We also expect to achieve non-IFRS net profitability in FY2026. Meanwhile, we have made meaningful investment in AI and the technology to make our platform smarter and more scalable. We look forward to share more on this initiative in the coming weeks. I will now hand over to our CFO, Phua, to walk you through our financials and the outlook in more details.
Thank you, Mike. Hello, everyone. I'm Phua, Chief Financial Officer of YY Group. Let me take you through our fiscal year 2025 results in more detail, starting with what drove our top-line growth. We operate in two core businesses, Manpower Outsourcing and Integrated Facility Management, DIFM. Both grew rapidly in 2025. Our Manpower segment's revenue was up 29% and our IFM segment was up 41%. In our Manpower segment, growth was driven by our ongoing expansions and fast scale-up in new markets, including Hong Kong, Thailand, and Malaysia, as well as strong and growing partnerships with brands across the hospitality and food and beverage sectors. In our IFM segment, growth came from two sources, organic client wins and strategic acquisitions. We complete several IFM acquisitions during the year, allowing us to provide clients with a full bundle of facility services through a single provider. This is steadily deepening our client relationships and creating new recurring revenue streams. Next, our bottom line. Our IFRS net loss for the year was $21.6 million. The majority was driven by non-cash items, $6.6 million in the share-based compensation and $9.6 million in impairment charges related to our strategic decisions to exit underperforming global subsidiaries. These charges represent deliberate actions we took to rationalize our portfolio and focus resources on our strongest markets. On a non-IFRS basis, our net loss was $7.8 million, compared with a small profit in the prior year. This is largely due to the front-loaded cost of entering multiple new markets simultaneously while building the operational infrastructure to support a much larger business. Importantly, we have already taken concrete steps to improve our cost profile, restructuring higher cost debt, streamlining our headquarters operations, and winding down non-core subsidiaries. And we expect these actions to deliver non-IFRS net profitability in fiscal year 2026. That brings me to our outlook. As Mike mentioned, we issue our first formal revenue guidance in March. Let me explain why we are confident in the $103 million to $110 million target. First, our Manpower segment is poised for fast growth. Since we acquired YYGH Hong Kong in April 2025, we have signed 20 hotel partnerships, demonstrating the strength of our market entry playbook and scalable technology. We see significant growth potential in Hong Kong in 2026, and we are replicating this playbook across Southeast Asia and beyond. In Thailand, we now serve iconic hotel brands including Shangri-La, Hyatt, Sheraton, JW Marriott, and the landmark Bangkok. In Malaysia, we are expanding beyond hospitality into the retail sector, rapidly growing our promoter workforce and building a stronger revenue pipeline. Meanwhile, our IFM business in Singapore now has a much broader service platform following our 2025 acquisitions. We have already won our first client in the banking sector as we continue to broaden our reach across verticals, and we see significant opportunities to cross-sell bundled services in our growing client base. Before I wrap up, a word on capital allocations. Our priorities are simple. Every dollar we invest goes towards scaling our core Manpower and IFM operations. We have also taken decisive steps to strengthen our financial position heading into 2026, retiring high-cost private debt, streamlining our headquarters, and rationalizing our global subsidiary portfolio to concentrate resources on our highest return markets. These actions give us a leaner, more efficient cost structure to support our next phase of growth. In summary, we expect the investments we made in 2025 to drive continued rapid growth in fiscal year 2026. We remain focused on building YY Group to deliver long-term value for our shareholders. Thank you for your continued support. We look forward to updating you on our progress throughout 2026.